Welcome to your Mortgage Insider Update. This week, we don't have a lot of big news, but we have big news coming. Into this week, the Personal Consumption Expenditure, or PCE, is the Fed's favored measure of inflation. It does tend to run a little bit lower than the CPI reports, which lead us to believe that inflation is at 3.5% right now. So we will see this Friday. We do expect somewhere in the twos, mid to high 2% range for PCE. They do strip out food and energy and have a secondary core PCE level, and that's what the Fed's really going to be focused at, is the core and super core inflation numbers when they meet for their next meeting coming up next month. So keep an eye out for that, but the market's not been kind to us as far as interest rates. We're going to take a look at the charts. So as of Wednesday, the 10-year Treasury is bounced around a bit. We're up 5 basis points today. If we take a look at that over the week, we've actually been kind of in a range here since the middle of April. We kind of broached above this level April 15th, hit high, and now just found the status quo. And unfortunately, the status quo is in a pretty wide range. There's a lot of room that we could come back down in interest rates with a positive PCE number this Friday. We could also see inflation rear its ugly head and push rates higher to levels that we haven't seen since back in October, which is where we saw the high point of rates. We also like to look at the mortgage-backed security pricing. So mortgage-backed securities sell and as their price drops, the interest rate to the consumer is rising because the investor is demanding a higher rate for their dollar. So as the 16 basis point drop we see here on mortgage-backed securities, this is down today, which has been similar, a flat range. We broached really negative back on April 15th, and then pretty much bigger moves than we saw in the 10-year Treasury. A little bit more of a volatile market. Mortgage-backed securities are also based on how many people are applying. So elevated number of people wanting to refinance would add a larger amount of supply. I think there, up until just recently, was an uptick in refinances. People are still trying to consolidate debt. So that's compounded the issue with more mortgage-backed securities coming to market at a time when investors are not so sure about buying those longer-term investments based on their projections of what the Fed's going to do. So that really is the question. What is the Fed going to do? And I don't think anybody thinks they're going to do anything right away. Their words speak volumes as far as the market's concerned. We've had a lot of Fed speakers out over the last couple weeks having speeches where they're, higher for longer seems to be the theme. They're very open to keeping interest rates where they are unless we get worse inflation or better inflation numbers as far as lower inflation, worse jobs numbers with more people claiming unemployment benefits, or an uptick in the unemployment rate, which just came down last month in March. So we'll see how this all plays out as we get into the springy months of May, which is just ahead. Have a great week.